of the financing effect of the project. So that what makes APV superior to NPV. That what makes the APV superior to NPV, because in NPV we don't look at how the project was financed, but in APV we now go into details to look at how the project was financed. So I think we shall look at the question. What is the question where they asked, what are the advantage of APV as compared to NPV? This is the main advantage of APV. That in APV, we look at how the project is financed. Because when you are going to finance a project using a debt, you are going to have a benefit of using a debt, as we saw in Morgan and Bennett. So we look at that effect of debt financing on the project. So what are the steps in APV? Steps in APV. The first step, or step number one, appraise the cash flows or determine the present value of or equity, or define the present value of an GRD business. Determine the present value of an GRD business. You're going to determine the present value of an GRD business. Now, what you need here, the cash flows may be the same, but what you need here is to discount the cash flows using the cost of an GRD business. That is, discount the cash flows using the cost of equity of an GRD. The cost of equity of an GRD business. Get your cash flows, the same way we have been looking at that. Then after that, discount your cash flows using the cost of an GRD business. That is step number one. Step number two, consider the effect of debt finance on the cash flows. On the project. Consider the effect of debt financing on the project. Here, you have to go a bit into details in this aspect. So first, when you're looking at this, what I look at interest rate has got a saving. First, look at the interest on the debt, or tax saving on the interest on the debt. Tax saving on the interest on the debt. That's the first. Look at the what is the saving on the interest of that debt. Now, the second aspect, look at if the debt is subsidized, or part of the debt is subsidized, look at the interest saving on subsidized debt. Interest saving on subsidized debt. If the debt is subsidized, for example, you may find that part of the debt you are going to get at subsidized rate, and another part is at commercial rate. So look at the saving you are getting on that subsidized. How much are you getting on subsidized debt? Then another thing that we need to look at here is interest saving foregone on the subsidized debt. Interest saving foregone on the subsidized debt, because or tax saving on interest, or tax saving. Sorry. Tax saving foregone on subsidized debt. That if you have got a debt, for example, if you are going to finance a project with 100 million, and maybe 50% of the debt is market. Sorry, is market maybe at 15%. Let's assume that. Then another 50%, you are getting it from the government. Another 50% of the debt, you are getting it from the government at 8%. So it means in this case, if I'm financing this, part of my interest, I'm going to calculate it at 15%. But by taking this, I'm foregoing a tax saving of 7%. So I recognize that as my opportunity cost. I hope you have got me on that side, on that issue.
Not clear, please.
We are saying you are getting a financing of 100 million or 100 million. But this loan is going to be 50% market. 50% is going to be market or commercial rate at 15%. This is a commercial. And another, this loan is subsidized from the government, and the interest is 8%. What does it mean? It means if I take this loan at 8%, I'm going to forego a tax saving at the rate of 7%. You're going to forego a tax saving which is at the rate of 7%, which should be recognized. That's what I was saying. We shall look at that maybe when we're looking at an example. Another thing that we need to look at in this is the issue cost. The issue cost can be on equity, the issue cost can be on the debt. What is the issue cost? Now, when you are analyzing the issue cost, there are two things that you need to look at. When you're analyzing the issue costs, there are two things that you need to look at. Sometimes the issue cost can attract tax, but not always. Other time, the issue cost may not attract.
Ntabwo tukumva.
I'm saying the issue cost sometimes can attract tax, sometimes may not attract tax. If the issue cost attract tax, it means you're going to have a benefit on that issue cost. If the issue cost does not attract tax, then you're only recognizing the cost of the issuing the debt. Now, what you should be very careful when you're analyzing your issue cost is that if a project requires 100 million, you're analyzing the project requires 100 million. And maybe you're going to finance this project with a debt. Let's assume that. You're going to finance the project with a debt. And the issue cost on the debt maybe is 4%. Let's assume that. So this means the 100 million you are having is 96%. It's not 100%. So when you are computing your issue cost, you should know that the 100 million is not 100. It is 96. So you should get, when you're computing, in this case, your issue cost will be 4 over 96 times then the 100 million to get your issue cost. Because this one is only 96% of the money that you got from the bank. And when you are computing interest, you should get the net amount plus the issue cost. Compute your interest. Please be very careful when you are looking at that. Be very careful. So I said each cost can have tax or may not have tax. So if each cost attracts tax, the tax should be recognized as a benefit. So if your each cost are going to attract tax, then you're going to recognize the tax as a benefit. I mean the tax that benefit as which reduces the total amount of each cost. Now, then step number last, your APV. Compute the APV, which would be step 1 plus step 2. You'll get step 1 plus step 2, and then compute your APV. But it requires you to be very careful. So there is a question that I want us to look at, which is here. There are 2 questions, in fact. I think there is this. Let's look at first this one, then we can look at another one, then we summarize this part. This is a question of 2023 April. Terimbere Company Limited is a listed company in the construction industry, which specializes in the construction of roads and bridges. TCL, or Terimbere, is considering a project that would involve an investment of 100 million. So this is our initial investment, or the data given. Data given, I have the initial investment, which is 100 million. I'm going to reduce 3 zeros, which is 100 million. And that will involve
you put net of which cost on that initial investment. You put net of
it is net of each cost. Okay. I need to write it where? Here. Oh, we shall get it. But we shall get it from that. It's net of each cost. And our annual cash flow, annual cash inflow.
This is 2022. Which month?
2023, I think. April. I don't know if I copied the right question 1. Annual cash flow is 55 million. For the next 3N, our N, or period, is 3. Then that's the period. At this period, you have no scrap value. Our scrap value is 0. Scrap value is 0. Then they have told us the machine will attract written down value. Depreciation is 25%. Per annum on reducing balance, with balancing out at the end of the project, when the machine is scrapped, with a balancing allowance. We shall recognize the balancing allowance at the end of the project. Remember, the residual value is 0. Then we have an equity beta. Equity beta, which is 1.29. And because of the new investment, firms in the same industry have an average equity beta. Average equity beta which is BE, which is 1 point what? 1.24. Then firms, am I reading the same? I skipped one. An equity beta is this, and debt to equity is this. Then this is equity beta ratio, debt to equity ratio. Debt to equity ratio. The debt to equity ratio is The debt to equity ratio is 1 to 3. Though this will change because of the new investment. Firms in the same industry have an average equity bet of 1.4, which I've captured, and an average debt to equity of 1.2. This is we are taking the average. Average debt to equity, which is 1 to 2.3.
But you have changed. First, debt to equity ratio is the 1.1 to 3.
But because they are saying because of this, because of the change in the industry, the change of the debt to equity ratio is going to change it to 1 to 2.3. That's what they are saying.
We are not seeing where you are talking about, because
am I the one reading the wrong information?
No, they are saying that
this ratio will change. This ratio will change because of the new investment. This is the current ratio, but it's going to change because of the new investment.
Okay.
So, and they are saying farming in the same industry have an average equity of this, and an average debt of this. So, because this is the current without that new business, but it's going to change to this, and it's going to change to this. Now, what else do we have? We have a risk-free rate, which is 5%. We have a market return, which is 90%, and the debt is risk-free. Okay? The corporate tax is payable in the same year at 30%. Our T is 30% in the same year. The debt beta is assumed to be 0 because it is risk-free. The new investment will be financed as follows. Debt is going to be redeemable in 3 years. It will be 30% times 100. And we get 30% times 100. That's the debt. Hope we are getting the data together. Equity is 70%.
Excuse me, sir.
We are lost, lecture.
Why do you times 100?
100 million, the total amount we need, 100,000.
Okay.
Where are you reading?
Where are you lost?
There.
Like that. Well, that's the investment we need. Equity, they are telling us it's going to be 70%. You are lost? So if you multiply this,
we are trying to check where is the debt of 100 million.
the total investment is 100. That's the money we need to finance the project.
First paragraph.
We need 100 million to finance the project.
Yes.
And this
then
why
are you multiplying by 30%?
You look at this data here. The new investment will be financed as follows. Debt redeemable in 3 years, 30%. And the equity, 70%.
Okay.
You have seen it? So that is it. Then each cost at 4% on gross equity. Each cost at 4% on gross equity and 2% on the gross debt. Remember, these figures are net. So what is the each cost on equity? Each cost on equity will be 4/96. Isn't it? Times 70. That will be the each cost. It is 4/96 times 70. That's the each cost on equity. And what's the each cost on debt? The each cost on debt is 2%. So it is going to be 2/98. Then times 30. So it's going to be 2 divided by 98 times 30. Yes, please, Wilson. Huh? I'm not, is it my microphone? But I'm not hearing you well.
According to the net.
I've not got you well, Wilson, but you can send the question in the message. I can read it. I can hear you well now. Because these values are net. They are net. They are not 100%, but they are net. It means for debt, it is 96%. Debt is 98% because the each cost is 2%. Equity is 96% because the each cost is 4%. Yes.
Lecturer.
Yes.
I can see on the requirement that they have asked to calculate the APV. If in case they have only said evaluate the project and advise management whether you are to continue with the project. What can indicate us that we need to calculate the APV in this scenario?
As long as you are going to finance the project using debt and equity, the appropriate technique should be APV.
Okay.
Yes. So now I think what have they told us? Each cost are going to attract tax. Any information on that? The corporate tax is payable in the same year at 30% of profit. But does it mean that the each cost are attracting tax? That one is a bit challenging. So our total each cost is it? You'll have this plus this. That's the total ish cost. So what is the now? Okay, we can now start our, remember our first step when you are using APV. These were just workings. The first step when you're using APV is to get the value of an geared business. That's the first step. What is the value of a business that is not geared? And how are you going to get that? You're going to get that value of an geared business by discounting your cash flows using the cost of an geared business. So basing on the data we have, automatically this tells us that we're going to use capital pricing model. Because you have a risk free, we have a beta, we have a market return. Automatically that tells you you're going to get the cost of the thing. It means my KU, cost of an geared, will be the risk-free rate plus asset beta into market return minus risk-free rate. But if you check in the data, we are only given an equity beta. We are not given an asset beta. In the data you have equity beta. So it means I have to use that information to get an asset beta. And how am I going to get an asset beta? My asset beta will be equal to VE times VE. That's the equity beta. VE plus VD into 1, sorry, minus tax 0.3 or minus T. Now, since I have this, I can substitute to get my asset beta. Because in this case, but I'm going to use the average. That reflects what is current in the market. So I'm going to use the current average equity beta and the current debt equity ratio after financing the business. So in this case, our asset beta.
Let us understand where the reason why we are going to use an average.
Yes.
Help us to understand the reason, the logic behind using average.
The reason we are going to use the average, the question told us that after financing the project, these ratios that we had previously are going to change. Although they have not given us the change, but they have told us the average, what is in the industry, where the company is operating. That's why we are benchmarking the industry.
Is it maybe because the project to undertake is going to be to fit in that industry in terms of risk?
Probably.
Okay.
So it means I'm going to take my VE, which is 2.0, which is, because this is debt to equity, it means VE is 2.3. 2.3 times 1.24 over 2.3 plus 1 into 1 minus 0.3. What do you get?
Where do you get 2.3?
What's this ratio? 1 to 2.3.
Okay.
Is the value of equity 2.3?
This is debt to equity. It means debt is 1, equity is 2.3. Is that it like that? Maybe I'm the one who
Yes.
The
Yeah,
value?
it is correct.
What's the value of equity there in that ratio?
2.3. The reason why we are confused is we were expected to calculate the value of equity, but that one is a ratio, just a ratio. Okay.
Maybe I'm the one interpreting it wrongly, but I think.
No, you are correct. But for us, we were not expecting that we are going to use the equity ratio, the debt equity ratio. We were expecting that we are going to calculate the value of equity, the value of debt, and you compute. Okay. But you are right.
Okay. And you are getting what?
It is 0.951.
You are getting?
0.951.
0.951.
It's better we stop on the 2 decimals. 595.
Okay. So now since I have the asset beta, I think I can get my cost of ungeared. The cost of ungeared will be equal to our risk-free rate is what? From our summary, 5%, and they have 9% market return. Is it true?
Yes.
Did I copy well?
Is it correct? Risk-free rate is 5. Market return is 9.
Is 9. Okay. So 0.05 plus 0.95 into 0.09 minus 0.05. And you get what?
For me, I get 8.8%. 0.8%.
0.8%. That's the cost of an GRD business. And it is the one that we should use to discount our cash flows to get the value of an GRD. They told us the cash flows are constant. Isn't it? These cash flows are constant. They are annual cash flows every year. They are constant. And we don't have a residual value at the end. So it means what's going to be the present value of these cash flows? The present value of cash flows. Hey, there is a tax. Oh, there is a tax. We need to get to working number 2. The tax saving. This is our period depreciation, net book value, then the tax saving. Period 1, period 2, period 3. So our cost of the asset is 100. So it means in year 1, depreciation is going to be?
That is tax saving on what?
Huh? On asset.
That is on asset.
Yes, hey, I think I should make it clear. Tax allowable depreciation. Let's make it like that. Tax allowable depreciation, which cost of tax. So remember our cost is it? Our cost is 100. That's the cost of the asset. And the depreciation rate, 25%. So it means here, we are going to have 25% is the cost, which is 100. And your net book value will be this minus this. So here, we are calculating on this times 25%. So this and if you remember, they told us in the question, they told us the scrap value at the end is 0. And they told us to recognize a balancing allowance. It means our balancing allowance will be this. Are we there?
Yes, sir.
Please
Yes.
elaborate on that.
Because in the question, they told us that the scrap value at the end of this is 0. But then they told us to recognize the balancing allowance at the end. So what would be the balancing allowance? It will going to be this value at the end of year 2. Yes, I've had someone also asking.
Yes, why do we put it under depreciation?
Why? Because it's like a loss. That if the asset had a value of 56 at the end of year 2, then at the end of year 0, you have 0 value. then it means you have a loss of 56 at the end of your project. So we are calculating this at this time 30%. So that is what we have as our savings. I don't know if you have a question there.
What is the useful life of the asset?
They told us 3 years.
You
3
always do
years
not get.
and the scrap value 0.
Okay.
3 years and then 0 scrap value at the end of 3 years. So now we can get our NPV, value of ungeared business. Can have year 0, 1, year 2, year 3, year 3, because we are paying tax in the same period. Our cash inflow, now the question is, that's the challenge we have. Now that's where we can fail. These 55, have they already charged the tax? But because they gave us as cash inflows. Yes? Members.
Yeah, in the third year on that asset, we are going to calculate the tax saving on the depreciation of third year.
Can you repeat the question?
Your voice is not getting out.
I'm saying, can you repeat the question?
Yeah, I was asking whether in the third year we're going to calculate the tax saving on the 55,
Yeah,
56.
because it is a loss. It is a loss we are getting, so we're having a tax saving.
Okay.
Yes. My problem is coming on this one, on this 55. Because the question told us is the cash inflow. Have they already adjusted the tax on it or not yet? I'm going to charge a tax because the question is not make. Or since it is cash inflows, we don't need to charge a tax on it. Then this is our earnings after tax. Then we have the tax saving. Here we have this. We have this. And we have this. Then our investment. Which is 100. So our net cash flows. net cash flows, we are going to have, I think here. Our discounting factor at 8.8, which is almost 9, eh? So in this case, 1 plus 0.88, eh? Then power minus this. So what will be the PV? Have this times this.
Lecturer,
Yes, please.
the cash in flow is not going to change.
It's not going to?
Change. Each year I can see 55,000.
Yeah, they told us it's going to be 55 annual. Annual cash flow, they're 55. Yeah. So what are our present value of any PV of an ERD business? An EGR will be, I'm going to add, that's what I get. Are we there together, friends?
Yes.
Sir.
Yes, question?
Yes. Yes.
Yes. Please ask. Hello, please ask the question.
No question.
I had someone who wanted to ask, but probably has gone off. The next is, yes? The next to get the debt tax benefit, or the benefits of debt. The debt tax benefits. Now, the debt tax benefits. First, we need to get the gross amount of the debt. What's the gross amount of the debt? Remember our net amount of debt. Our net amount of debt was 30, when we calculated 30 million. Then we have an issue cost. We have an issue cost, which is how much? An issue cost of the debt, which is this one. So our gross is this. That's the gross amount of the debt. Are you there? Now, what is going to be the interest on this debt? Interest on the debt at 9%. So that's what was given in the question. It's going to be this times 9%. I think we get that. And what will be the tax saving on debt at 30%? We are getting this times 30%. I get that tax saving on the debt. Anything else we need to calculate?
Where is this 9% coming from?
Maybe I'm the one who got it wrongly. Let's go back. I saw as if it is the same, 9%. Look at here. Maybe I'm the one who misled it. The risk-free rate is 5%. Isn't it? Then the market return is 9%. And the debt is risk-free. It is 5%, not 9%. So we are using 5%, not 9%. Because the debt is risk-free, means we are using the 5% here as the interest on the debt. Is it okay? Or is my interpretation?
Debt is free.
They said the risk-free rate is 5%.
Hmm.
Is it okay? The market return is 9%. Is it okay?
Yes.
And they said, and the debt is risk-free, meaning it's a government bond, it is a treasury bill. So what is the interest on the debt?
It will be risk-free rate.
The risk-free rate will be the interest on the debt. So this is 5%. So I think we have finished everything based on the question we have. My worry, we are not told whether I'm not going to consider whether the each costs are adapting. Because the question has not told that. So it's a gamble in that.
If they did not say it, we will assume that we will not attract tax.
That's what we are assuming, that the debt is not attracting tax. There's no each cost. Tax on each cost. So now it means I'm now taking my, I'm going to complete my APV. So I'm going to get the NPV of ungeared. NPV ungeared. We already got it as it.
I think it's better you say tax saving on interest.
Okay. NPV ungeared, we have it. We have the tax saving on interest. which is this. Then we have each cost. Which we got as the each cost on the debt we got. This is why I added the total, which is this. So what is our APV? I don't know if you have a question on this. Yes? Any question, members, on this? You are not saying a word. What is wrong? I think that
For presentation purpose, can you go down again?
I'm copying this and then I copy to the where we are working from. Below the question, which can make it easy for you to read. That's where we are. So in that case, we accept the project should be taken. The project should be undertaken. Any question, members? You are not saying a word. You are keeping quiet.
No question, sir.
My
It's
question
the
is
matter
about-
of doing so many questions so that we can,
Okay.
yeah.
My question is about the issue cost. Is it because it is like it is issued at the year zero? That is why we are not discounting it.
Yes.
Issue cost.
Yeah, it is at year zero.
Okay.
Now we can look at another one question,
Hello,
I think.
sir.
Yes, please.
Excuse me.
Yes.
Before we move on, I want to ask on working number 2 for the tax allowable depreciation.
Yes.
I'm seeing that the tax saving is 10% of the net book value.
The taxi?
The tax saving. The
I
last
don't
column.
want to take that assumption. I have been hearing even other students talking about that. Please, I don't want to take this assumption. Why don't you calculate it normally? What is wrong of calculating it normally? I don't want to take that assumption. Sometimes it can change. Yes, I hear people talking about it sometime like that. I've never approved it. I cannot give a comment on that. Now look at this one in the last year. What will you write? Is it 10%?
10% of what?
Because what they are looking at is some people are questioning here on the net.
Your voice is not getting out well.
Oh, I don't know, maybe.
Okay.
I'm saying in some, I always hear it from students. For me, I've never read it somewhere. That's I can confess. I've never read it somewhere that tax
We
saving
don't even understand the question.
is saying that tax saving is calculated as 10% of the net book value. And I don't know where the concept is coming from, but it's not always. That's what I can confess on my side. It is not always. For example, if you look here, it's true 10% here. Even here, true 10%. What about here? In the last year, you may end up messing it up. So my advice, you should calculate 30% on your depreciation base. On your depreciation. That's my advice. Don't take the 10%. Please calculate your saving on your depreciation base. Is it okay?
Okay, thank you.
Yes.
That's how even I wanted to know how we've got like 30% of depreciation. Yeah, thank you.
Okay. So any question, any other question on this? We are summarizing it. We are going to this other question. I forgot the paper. I don't know how the paper came out. Let me check back at the paper that I copied this question. I think it was this one. Yeah. It's November 2023. November 2023, still question number 1. This part is very common, very common, very common. APV is very common question asked. Please follow the steps, master the steps that you need to use to get your APV. It's a very common question. It cannot miss 2 sittings, cannot miss more than 1 sitting without coming back. Let's look at this one again. Instant Power Limited is hydroelectric power plant with an impoundment facility.
Lecturer, that is for which year?
2023 November. 2023 November.
Okay. Question, okay. That's the question number 1.
Question number 1. Instant Power Limited is hydroelectric power plant with an impoundment facility. The company has established a project to build hydroelectric power plant in Bugesera. The company intends to purchase an initial crucial machinery for 100 million. So it means our IO is 100 million. If I'm capturing this data, is 100 million. The machine is expected to operate for 25 years, useful life. 25. And get fully depreciated. Residual value? Residual value is 0. IPL predicts that it will earn earnings before interest and tax. Our EBIT is 14 per year for 25 years. This is per year for 25 years, the useful life, with effect from the end of the first year. With effect from the end of first year. Okay, end of the first year. So it's the same. The company pays corporate tax. Our T is 30%. The company's investor requires a return, a 12% rate of return for the projects under all equity financed. It means this is a KU because it's all equity financed. Our cost of ungeared is 12%. That's the cost of ungeared. Now, it says, and other equity financing and the pre-tax cost. Our KD, which is pre-tax, is 9.5. Because of the extent of the grid electricity is limited and mainly concentrated near the capital city, the government will subsidize the project with 50 million 20-year loan and interest rate of this. Subsidized loan is subsidized loan at 6% is 50. Then it means market loan at 9.5 is also 50. The government expand the capacity mix national project. The government has also allowed the to pay the principal in a single amount, in a single payment at the end of the loan. So the loan is going to be paid at the end. So it's not going to be an annual payment. I don't know whether the interest will be annual. The single payment of the principal. Not the interest will be paid, but the principal will be paid at the end. And what is required? Using appropriate calculation, estimate the adjusted present value of IPL proposed. Then differentiate between APV and NPV as a method of investment. I think that one you can talk about it. Oh, my network is becoming low. So I think it's the same principle that we have been following. The good thing this time, yes.
Excuse me, sir.
Yes, please.
Where do you come with market loan at 9.25%? That 50 million.
Maybe I'm the one who have misinterpreted the question. Maybe let's go back. We are going to invest in machinery 100 million.
Yeah.
And they have not told us that we are going to, they are saying the investment is going to be financed by by debt, of which the government is giving us 50 million on that investment. So how much are you going to finance within the market loan?
Is it 50?
Is it 50?
Okay.
For me, I'm not seeing that.
Eh?
Where are you reading? Maybe I'm lost.
This is the money we require to invest in the machine.
Yes.
Is it okay?
Mm.
And how is it going to be financed?
Mm-hmm.
They said, and a pre-tax cost of debt is this. Because of the extent of the grid is made, the government will subsidize the project with a 20-year loan. Is it okay?
Yes.
With the 20-year loan at an interest of 6%. Maybe, so this is the government loan. What about the balance? Is going to be financed by what?
Make the value maybe.
But yes, maybe market value, but it's not showing us the loan value, the loan. That loan will be of how long?
That is the problem.
The market loan. Can we take them as 2020, the same period? That's the challenge we are facing for the market loan. Is it also 20 years or it's going to be 25 years? Okay, let's move on. Then we shall look at the data, the way it moves. Now, if you look at the data we are having, of course, we need the NPV of an Nigeria business. And if we need the NPV of an Nigeria business, automatically, we shall have to get the two things. We need to get the depreciation of the asset. Which is going to be the depreciation of the asset it is 100 minus 0 divided by 25. And we are going to get 100 divided by 25. That's the depreciation. And they have told us the asset will depreciate fully to 0 in the last year. And they have not told us that we are going to have a balancing allowance at the end. So what's going to be the tax saving on this depreciation? On depreciation. At 30%. That's the tax saving on the depreciation. So, what is going to be our net cash flows? Maybe working number 2.
Have we been told that we are having a tax allowable depreciation?
No, it's not given, but they said from here. That's what I'm thinking, but it's not given. The machine is going to operate 25 years and they get fully depreciated.
Mm-hmm.
Is it okay?
Mm.
If IPA predicts that it will earn these earnings, so don't we need to calculate? They have given us a tax rate. Don't we need to calculate a tax saving on depreciation?
No, for me, I see we can calculate only the depreciation. Maybe the asset is not allowable depreciation.
Sure. Let's hear from others. For me, I'm thinking that because we have been given that asset is depreciating and is going to have a tax, there's a tax rate, we need to calculate this depreciation. Let's hear from others. What are you saying on this part? Or you will check in the past paper in the solution.
No.
But for me, I'm thinking.
For me, I
that
think
may
as
not
long
depreciate.
as we have, hello?
Yes.
As long as we have tax rate and the depreciation,
We need to calculate the
automatically tax saving, tax allowable is there.
Yes, that's also what I'm thinking. But maybe you can check the solution and see what the examiner wanted to say about that. Annual cash inflows. Because this is 25 years, we are not going to compete for up to 25. Since the cash flows are constant, we can get the annual. So our EBI DT, we said it is 14. Less tax. At 30%. This. And with 30%, you have that. Then I have my EAT. Then I consider the tax saving. Tax saving, which is 1,200. Then my annual cash flows will be annual cash flows. Now, remember.
What is working number 1, lecturer?
Working number 1, we have calculated this tax allowable depreciation. Remember, these cash flows are annual every year, up to 25. So what, and our KU is given in the question instead of percent. That's the KU. So what is going to be our annuity factor? We need a present value interest factor annuity of 12%, period 25. Present value interest factor annuity, 12%, period 25. You get what? So I'm going to put in the formula 1 minus 1 plus 0.12 power minus 25 divided by 0.12. That's the annuity factor. They said 2 decimal points. So what will be the present value of the cash flows? I'll have this times this. I have this as my present value of the cash flows. My initial investment is 100. So the NPVU will be that. You can tell me if there's somewhere I've skipped. If there's an information I've skipped on this. Anything I've left out? Maybe we can call this one. Is it the annual cash, or we can call it the NPVU, because that's the last results. Then working in number 3, you need the present value of the debt tax. Present value of debt tax shield. Present value of the debt tax shield. Now, we have 2 loans that we need to look at this. We have a subsidized loan and we have a market loan. So if you look at our market loan, we are having our gross loan. Our gross loan is 50. That's the gross loan. Interest on the loan, interest at 9.5%. Will be this times 9.5%. Then our interest tax saving at think we made a mistake in the other part. We didn't get the present value. We only calculated the interest. We didn't get the present value. I think we made a mistake somewhere there. Hey, did you get the present value? At 30%, we get this times 30%. Now, what we need again here is the present value of the interest tax saving. Present value of interest tax saving. See, this is what I'm talking about. You may not have put this interest tax saving. So what is our annuity factor in this case? Maybe I can first get the annuity factor. That's why I have it. What is the annuity factor? We are going to use the same period, 20 years, because they have not told us the loan is going to be of how long. But the government loan is...
A question.
Yes.
I can see on this question, we are calculating the present value.
Yeah, that's what I said. In the other question, we made a mistake. We didn't calculate the present value. We only took the interest saving, but we should take the present value, not the interest saving. So you can correct that. Or I will correct it in the year.
How should we get the present value? We should do also this.
Get the annuity factor. I think it was I'm going to make it correct it. It was here. It was here. I'll not add the annuity here. I can add the annuity factor. Because it is for 3 years. And our rate was how much? Is it 5%? And it was 1 minus 1 plus 0.05 power minus 3 divided by 0.05. Yeah, that's what we should take. The present value. We want to take for 1 year. It should be for the present value.
One year, why? Why do
3 years.
do?
We should use 3 years, not 1 year. Because the years were 3.
Okay.
Yeah. So you can collect that.
Then you can write that is the present value of
interest. Present value of interest tax saving. So our annuity factor, are we using 25 years? Because the project is 25 years. So we are going to use 25 years of the project. So it's going to
How much did you get?
why not 20?
20 is the loan, but the project is 25 years. The loan is not telling us how much the market loan is going to be given. So we are going to have the annuity factor 1 minus 1 plus 0.095 power minus 25 divided by 0.095. So that's to put the smaller points. Huh? So our present value of interest tax saving will be this times this. That is one. Now we have an interest saving on a subsidized loan. We have a subsidized loan. Our interest on subsidized loan, interest will be interest at percentage at 6%. We are getting subsidized loan is how much? Okay.
You mean gross amount, gross loan?
Yes. If it also. Isn't it?
Yes.
Interest at 6%. We are getting this times 6%. Then tax saving at 30%. I have this times 30%. Then what's my annuity factor? My annuity factor will be one minus 1 plus 0.095. Now this one is a challenge. Are we using, because this one, this one is 20 years. It's not 25 years. I think the information was not very clear there. We will cross check. This is 20 years.
Doctor, why are you using 9% instead of 6%?
Aha, that is good. Both market loan. Please mute. Both the market loan and the subsidized loan should be discounted using the same cost of capital. Does it make sense? Both the market loan and the subsidized loan should be discounted using the same cost of capital.
Is 9% the cost of capital, or it is the interest rate?
9.5, the market date. The market date.
Yes. So how should we consider this as a Cost of capital.
That's the same cost of debt. The one with the cost of the market is the one which is considered as the cost of the debt. So when you're discounting, you should use the same cost of debt, which is the market
What if
interest rate.
if you use the risk-free rate
of it depends on the type of the debt. It depends on the type of the debt you are looking at.
No, the same scenario. Maybe they include the risk-free rate. If you use to discount this using the risk-free rate, is it a mistake?
But in the question, do you have a risk-free rate?
No.
So in that case, there's no way you're going to apply it. So what's the PV? You are getting this times this. Oh, we are rounding off too much, and they told us 2 decimal points.
So at this point, you have used the 20 years or 25 for annuity factor.
Is it 20 years? But I'm about to ask the lecturer why she didn't use the 25 years.
You know, the issue, I'm not using 25, although the project time is 25. I agree. I'm not, but my worry is this debt is going to be paid in 20 years, not in 25 years. So yes, it is a challenge on how to match our cash flows. But how are you going to look at this? Should we use 25 years? Are you going to get this benefit for 25 years? Or the benefit is going to stop in 20 years? Are you getting my issue? Maybe I'm the one who's thinking so much. Because what we are recognizing is a benefit. Are you going to get this benefit in 25 years when the loan is paid in 20 years? Or the benefit will stop in 20 years? What do you say? What do you say? Are you going to get the benefit for 25 or you're going to get the benefit for 20 years?
For 20 years, as they said that
the loan is paid in 20 years. That's what I'm thinking also.
That the loan will be paid in 20 years at an interest rate of 60% per year.
So that's what I'm thinking, but you can cross-check in how the examiner made it. But if it is me, there's no way I can accrue that for 25 years because the benefit for this loan is stopping in 20 years. The other one we have used 20 years because we assume that the benefit is going to accrue to 25 years when the loan will be paid. But if that loan they have told us that the loan will be paid in 20 years, it means the benefit will stop in 20 years. But you can cross-check and see. Maybe my approach may not okay. Maybe I interpreted it wrong, what the examiner was thinking. But for me, that's how I see it. Now, we are also saving an interest. We have this. We have this. Interest saved on the market loan, subsidized loan. How much interest was saved on this subsidized loan? So our interest saved will be interest saving. Will be 9.5% minus 6%. Then times 50. I'm removing this. You'll remember that. Yeah? Which is going to be this times 63.5%. I get the interest which was saved. So in this one, I don't, because this is the saving I received on the interest. So it means in this case, our annuity factor, I'm going to copy this again. Because we are saving this interest for 20 years, not for 25 years. We are saving the interest for 20 years, not 25. That's for me how I interpret it, but you can also cross-check and verify my interpretation. So the present value of interest saved
is 175 only, not 1750
it is also
on interest saving.
present value of interest. Hey, how would I multiply?
I don't know.
Are you not multiplying by 50,000? It's 50,000. Can you cross check? This is 50. Can you cross check again?
Yeah, it's okay.
So I have this time with this. Okay. Now what is missing? We are missing is one part. Tax foregone on interest saved. Tax foregone on interest saved. Tax foregone on interest saved. So our interest saved is this our tax on interest saved at 30% is this times 30%. Our annuity factor, we have the same. I take this. But please you cross-check and see whether they are also using 25 or the examiner used the 20, but it does not make sense to use 20 for this part. Does it really make it 20? Although the project is 25, but does not make sense to use 20. So our PV of tax foregone on interest saving will be this times this. So now I think we are almost.
Excuse me.
Yes.
Can you show us how you come up with 4,625.6?
I'm back on that formula.
What I got this times this. The annuity factor times 525.
Okay.
Yes. So what is remaining? I think we have all the variables. We don't have each cost. We don't have each cost on the question.
We have them some.
Each cost?
Yes.
Then it means what we have calculated is wrong. In this question, maybe I didn't copy it. Each cost. Where? Do you have each cost in this question?
Sorry, there is no issue
We
cost.
don't have.
I think there is no each cost in this question.
Excuse me.
Yes.
What is depreciation amounting to 14 million per annum for 25 with effect from end of first year?
The 14, that's the implication of that. Because cash flows are always at the end of year. It means if this is year 1, year 2, at the end of year 1, you will get that 14 million.
Okay.
Yeah. So that is I think we can now get our NPV. I don't know if there's something I've left out. We can cross-check also and maybe modify that. So we are now getting our APV. We have NPVU, which we calculated as this, I think. Have the PV interest on a market loan, which we calculated as it is this one. See the market? See the subsidized. This one, we have a PV interest on subsidized. On subsidized loan, which we calculated as this. We have a PV interest, a PV on interest saving. Interest saving, which we have calculated as this. We have a PV of tax foregone, which is a cost, and it's going to be this one. So my APV will be this. So still you are accepting. Yes? Any question? Any question, members?
Not a question on that, but just on question number B, because we need to understand that the comparison between the APV and the NPV.
As I said when we are starting, the strength of APV is about financing effect. That's the only issue. If you look at APV, differentiate. If you look at APV and the NPV, the main strength that this one it considers the financing effect. Financing effect of the project. This one does not consider. Does not consider the financing effect. Here I don't consider the financing. The financing effect. That's the main difference, but I'm seeing 5 marks are too much in this. So it does not have anything else, but they need like 3, I think, points. But that's the main that for me, I know that he separated these two.
But the fact that they are putting 5 marks, it means we need to give at least 5 points.
Attached to 3 on each side. But still, you can check in the marking guide and get those ones. So for me, I only know one. That one.
Okay.
So I'm copying this to. I don't know how it. Eh? Okay. So members, I think that's it. For this part, which is, I said, this is a very common question. Very common question. So please go into deep to apply, but know those steps. The challenge that always, the challenge that is always you need to be very careful is the cost of ungeared. And analyze your cost. Sometimes they can say the current KE is this. Maybe the current KE is 10% or 10%. That's the current KE. Debt to equity ratio, maybe it's 2 to 5, 2 to 4. That's the debt to equity. And our pre-tax KD, maybe it's 8%. Automatically, once you see such information, it means you're going to use Modigram and Mira. Because in that case, to get KU in this part, you have to apply a Modigram and Mira theory. So my emphasis, please look at this question well, look at the cost of ungeared, then apply the debt tax sheet as may be. Where you have each cost, find out if each cost are on net or are on the gross amount. That is my take home on this part, which is a very common area. Please, I don't expect that you'll fail it once you follow what we have talked about. Any question?
There are two factors to pass this paper. Number one is the revision. Number two is to give us a lot of